Journal entries, basic interview questions and answers for beginners. What is journal entry? A journal entry in accounting is a record of a financial transaction that is entered into the general ledger. It represents the first step in the accounting cycle and captures the details of the transaction, including the accounts involved, the amounts debited or credited, and any additional information necessary to describe the transaction. Journal entries are typically recorded in chronological order and serve as a foundation for preparing financial statements and analyzing business transactions. What are the 7 important types of journal entries? Here are the 7 important types of journal entries used in accounting. Simple entry, a basic journal entry involving a single debit and credit, usually used to record straightforward transactions like cash sales or purchases. Compound entry, a journal entry involving multiple debits and/or credits, used for more complex transactions that affect multiple accounts simultaneously. Opening entry, an entry made at the beginning of an accounting period to record the balances of various accounts brought forward from the previous period. Transfer entries, entries made to transfer balances from one account to another, such as transferring funds from one bank account to another or reallocating costs between departments. Closing entries, entries made at the end of an accounting period to close temporary accounts, such as revenue and expense accounts, and transfer their balances to the retained earnings account. Adjustment entries, entries made at the end of an accounting period to adjust accounts for accruals, deferrals, depreciation, or other adjustments needed to ensure accurate financial reporting. Rectifying entries, entries made to correct errors or mistakes in previously recorded journal entries, helping to rectify the financial records and ensure accuracy. These 7 types of journal entries cover a wide range of transactions and adjustments commonly encountered in accounting processes. Where can you use journal entry and why? Journal entries are used in various stages of the accounting process to record and track business transactions. Here are some specific instances where journal entries are used and why. Initial recording, journal entries are used to initially record business transactions. This helps maintain a systematic and accurate record of all financial activities in the general ledger. Adjusting entries, journal entries are used to make adjustments at the end of an accounting period to ensure that financial statements reflect the correct financial position and results. Adjusting entries can include accruals, deferrals, depreciation, and other necessary adjustments. Closing entries, journal entries are used to close temporary accounts, such as revenue and expense accounts, at the end of an accounting period. This process helps transfer the balances to the retained earnings account and prepares the accounts for the next period. Rectifying errors, journal entries are used to correct errors or mistakes in previously recorded transactions. These entries help rectify any inaccuracies in the financial records and ensure that the financial statements present a true and fair view. Special transactions, journal entries are used for special transactions that may not fit the regular recording process. Examples include recording the issuance of stock, loan transactions, adjustments for foreign currency transactions, or other unique events that require specific journal entries. By using journal entries, businesses can maintain accurate and detailed records of their financial transactions. Journal entries provide a chronological and comprehensive trail of all business activities, making it easier to analyze financial data, prepare financial statements, and comply with accounting standards and regulations. What is debit and credit? Debit refers to an entry made on the left side of an account in the general ledger. It represents an increase in assets, expenses, or losses and a decrease in liabilities, equity, or revenue. Debits are typically used to record the receipt of assets, payments made, or expenses incurred. Credit refers to an entry made on the right side of an account in the general ledger. It represents an increase in liabilities, equity, or revenue and a decrease in assets, expenses, or losses. Credits are generally used to record the provision of goods or services, receipt of income, or an increase in liabilities. What is ledger? A A ledger can be referred as an accounting book that keeps the record of journal entries in a chronological order to individual accounts. The process of recording these journal entries is known as posting. What is general ledger? The general ledger is the central accounting record that contains all the financial transactions of a company. It serves as a comprehensive repository of all accounts, including assets, liabilities, equity, revenue, and expenses. The general ledger provides a detailed and organized overview of the company's financial activities and is used to prepare financial statements and reports. It is typically maintained using double-entry bookkeeping, where each transaction is recorded with a debit and credit entry in the appropriate accounts within the general ledger. What are the differences between auditing and accounting? Auditing and accounting are two distinct but interconnected disciplines in the field of finance. Here are the key differences between auditing and accounting. Accounting. Accounting involves the recording, summarizing, analyzing, and reporting of financial transactions and information. Accountants are responsible for maintaining financial records, preparing financial statements, analyzing financial data, and providing financial insights to help businesses make informed decisions. The focus of accounting is primarily on the accurate and reliable presentation of financial information, compliance with accounting standards, and providing financial information for internal and external stakeholders. Auditing. Auditing involves the examination and evaluation of financial records, statements, systems, and processes to ensure accuracy, reliability, and compliance. Auditors are independent professionals who assess and verify the financial information prepared by accountants. They provide an unbiased opinion on the fairness and transparency of financial statements. The focus of auditing is to provide assurance to stakeholders, such as investors, lenders, and regulators, regarding the accuracy and reliability of financial information. Adherence to accounting principles and standards, and identification of any financial irregularities or fraud. What do you mean by working capital? Working capital refers to the difference between a company's current assets and its current liabilities. It represents the amount of funds available to a business for its day-to-day operations and is a measure of the company's short-term liquidity. Working capital is calculated using the following formula. Working capital is equal to current assets current liabilities. What is compound journal entry? With example, a compound journal entry is a type of journal entry that involves multiple debits and/or credits. It is used to record complex transactions that affect multiple accounts simultaneously. Compound entries are typically used when a transaction involves multiple aspects or multiple accounts are affected by a single event. Here is an example of a compound journal entry. Let's say a company purchases office supplies on credit and also pays cash for the remaining amount. The total transaction involves both the accounts payable and cash accounts. Office supplies purchased on credit, $500. Cash payment made, $300. To record this transaction, a compound journal entry would be used. Date of the transaction. Accounts payable $500. Cash $300. Office supplies $200. Explanation. The accounts payable account is credited for $500 to record the increase in the liability owed to the supplier. The cash account is debited for $300 to record the cash payment made. The office supplies account is debited for $200 to reflect the increase in assets. What is the biggest difference between accounts receivable and accounts payable? Accounts receivable represents the money owed to a company by its customers for goods or services sold on credit, while accounts payable represents the money owed by a company to its suppliers or vendors for goods or services purchased on credit. What is double-entry accounting? Double-entry accounting is an accounting method where every financial transaction is recorded with at least two entries, ensuring that debits equal credits. It follows the principle that every debit must have a corresponding credit, providing a balanced and accurate representation of a company's financial transactions. What is an over-accrual? An over-accrual refers to a situation where an expense or liability is recorded in excess of the actual amount owed or incurred. It occurs when an organization estimates or accrues more than the actual expense or liability that will be recognized. This can result in an overstatement of expenses or liabilities on the financial statements. Over-accruals are typically adjusted in subsequent accounting periods to reflect the accurate amount of the expense or liability. Correcting over-accruals helps ensure the financial statements provide a true and fair view of the organization's financial position. Or, an over-accrual occurs when the estimated amount for an accrual journal entry is excessively high. This overestimation can result in the inclusion of inflated expenses or income. As a result, corrective measures are necessary to adjust the accrual to reflect the accurate amount. By rectifying the over-accrual, the financial statements can provide a more accurate representation of the organization's financial position. What's reversing journal entries? Reversing journal entries are entries made at the beginning of an accounting period to reverse the effect of certain adjusting entries made in the previous period. These entries are typically used for accruals or deferrals that were recorded in the prior period but are no longer applicable in the current period. Reversing entries are often used for items such as accruals of expenses or revenues, prepaid expenses, and deferred revenues. Why is it easier for somebody to perpetrate fraud employing a journal entry than with a ledger? It is easier for someone to perpetrate fraud using a journal entry than with a ledger because journal entries are typically made at the transaction level and may not be subject to the same level of scrutiny as ledger entries. Journal entries can be manipulated or fabricated to misrepresent transactions or hide fraudulent activities. Additionally, journal entries can be made without leaving an audit trail, making it harder to trace and detect fraudulent behavior. The ledger, on the other hand, consolidates and summarizes the information from journal entries, which undergoes more scrutiny and review, making it harder to manipulate without raising suspicion. What's the journal entry for goods given in charity? The journal entry for goods given in charity would vary depending on the specific circumstances and accounting policies of the organization. However, here is a sample journal entry based on the assumption that the goods given in charity are accounted for at their fair market value. Example. Date of the transaction. Charity expense $500. Inventory $500. What's journal entry for free of charge samples? When providing samples free of charge, the journal entry would typically involve recognizing the cost of the samples as an expense. What is depreciation? And different types of depreciation? Depreciation is the systematic allocation of the cost of an asset over its useful life. It represents the decrease in value or usefulness of an asset due to factors such as wear and tear, obsolescence, or passage of time. There are several types of depreciation methods used to allocate the cost of an asset. Straight-line depreciation. Declining balance depreciation. Units of production depreciation. Sum of years digits depreciation. Double declining balance depreciation. MACRS, Modified Accelerated Cost Recovery System. Here is an example of a depreciation journal entry. Assume a computer with the cost of rupees 50,000, a useful life of 5 years, and no residual value. The depreciation method used is the straight line method. Date of the depreciation entry. Depreciation expense 10,000 rupees. Accumulated depreciation 10,000 rupees. Explanation. The depreciation expense account is debited for the amount of depreciation for the specific period, rupees 10,000. This expense is recognized on the income statement. The accumulated depreciation account is credited for the same amount, rupees 10,000. This account is a contra-asset account and represents the cumulative depreciation recorded on the balance sheet. By recording this journal entry, the cost of the computer is gradually expensed over its useful life, reflecting the reduction in its value due to wear and tear or obsolescence. What are accruals in accounting? Accruals in accounting refer to the recognition of revenues and expenses in the financial statements before the cash is received or paid. They are used to ensure that financial statements reflect the economic activities and financial position of a company accurately, even if cash transactions have not occurred yet. There are two types of accruals. Accrued revenues, these are revenues earned but not yet received in cash. They represent the amount owed to the company by its customers or clients. Accrued revenues are recorded as assets on the balance sheet and as revenues on the income statement. Accrued expenses, these are expenses incurred but not yet paid in cash. They represent the obligations or debts that a company owes to its suppliers, employees, or other parties. Accrued expenses are recorded as liabilities on the balance sheet and as expenses on the income statement. What are drawings and journal entries? In journal entries, drawings refer to the withdrawal of cash or other assets from a business by the owner for personal use. Drawings are typically made by the owner of a sole proprietorship or partners in a partnership. It represents a reduction in the owner's equity or the partner's capital account. When recording drawings and journal entries, the owner's withdrawal is typically debited to a drawings account and credited to the cash or the relevant asset account being withdrawn. Where a cash discount should be recorded in a journal entry. A cash discount should be recorded in a journal entry as a reduction in the amount of cash paid to a vendor or supplier. It is typically recorded in the accounts payable or purchases section of the general ledger. Where a cash discount should be recorded in a journal entry. A cash discount should be recorded in a journal entry as a reduction in the amount of cash paid to a vendor or supplier. It is typically recorded in the accounts payable or purchases section of the general ledger. Here is an example of a journal entry for recording a cash discount. Date of the transaction. Accounts payable $1,000. Cash $980. Discounts $20. Explanation. The accounts payable account is debited for the original amount owed to the vendor. The cash account is credited for the reduced amount actually paid, reflecting the cash discount. The discounts account is credited for the value of the cash discount received. What is deferred tax liability? Deferred tax liability is the amount of taxes for which a company has not paid the full amount but is expected to be paid in the future. However, it doesn't account for a company's unfulfilled tax obligations but is actually payments that are not due yet. It could signify that an organization company may pay more tax in the future owing to current transactions. What are contra entries? Contra entries, also known as contra accounts or contra entries, are journal entries that are made to offset or reduce the balance of another related account. They are used to provide a clear presentation of financial information and to separate specific transactions or adjustments from the main account. Give an example of purchase and sales journal entries with GST. The Goods and Services Tax, GST, is applicable to purchases and sales transactions. Here are examples of journal entries for purchases and sales transactions with GST. Purchase journal entry with GST. Assume a purchase of goods for Rs 10,000 with a GST rate of 18%. Date of the transaction. Purchases 10,000 rupees. Input CGST, current assets, Rs 900. Input SGST, current assets, Rs 900. Accounts payable 11,800 rupees. Explanation. The purchases account is debited for the net amount of the purchase, Rs 10,000. Input CGST account, current assets, is debited for the CGST component, Rs 900. Input SGST account, current assets, is debited for the SGST component, Rs 900. The accounts payable account is credited for the total amount including GST, Rs 11,800. Sales journal entry with GST. Assume a sale of goods for Rs 20,000 with a GST rate of 18%. Date of the transaction. Accounts receivable 23,600 rupees. Output CGST, current liability, Rs 2,100. Output SGST, current liability, Rs 2,100. Sales 20,000 rupees. Explanation. The accounts receivable account is debited for the total amount including GST, rupees 23,600. Output CGST account, current liability, is credited for the CGST component, rupees 2,100. Output SGST account, current liability, is credited for the SGST component, rupees 2,100. The sales account is credited for the net amount of the sale, rupees 20,000. To obtain further information on the topic at hand, we recommend reviewing our previous videos. These videos contain additional details and insights that may prove useful. We encourage you to watch them to deepen your understanding of the subject and gain a more comprehensive perspective. We hope you find our previous videos informative and valuable in your pursuit of knowledge.